Hello everyone. Today we are looking at an educational case study on how currency fluctuations can completely distort the geometry of a chart. On my screen, I have overlaid two different listings of the exact same company, HDFC Bank. The red and green candles at the bottom here represents its US listing as ADR, the American Deposit Receipts, trading at the New York Stock Exchange, and the blue line on the top represents the native listing on the National Stock Exchange, the NSE in India. So if you start looking at the candles at the bottom here in the US market, it is actually printing a classic Elliott Wave ABC zigzag pattern or a correction. Wave A bottomed out in 2022, while wave B made a clear lower high in 2025, and the recent wave C has flushed straight down, and we can notice how perfectly it has reacted to the yellow line at $22.76, which actually marks the almost exact 100% Fibonacci extension of wave A projected from wave B. We have just two trading sessions left in the month to see how this monthly candle closes, but as of now, it is printing a powerful bullish engulfing pattern right at the macro support. So if this 100% extension support breaks, the next major support and the line in the sand would be $21.36. If even this support breaks, then we'll have to reevaluate the count, and it would actually mean that a further deep correction might be in place. Now looking at the blue line directly above this, which actually tracks the local Indian market, we can see some choppy price action uh, over the last few years. I did actually consider an ending diagonal or also even a triangle pattern here, A, B, C, D, E. However, a running flat looks like uh, a much better structural fit simply because triangles and diagonals require slower and overlapping corrective subwaves. But this massive 2026 flush, by contrast, behaves like a sharp, high velocity five-wave impulse, which is the classic signature of wave C in flats. So wave C in flats end in five waves. But of course, let's see how the price action behaves from here. But what makes this overlay good is the vertical dashed lines for February 2021 here, May 2022, and then July 2025. The macro peaks and troughs, the macro peaks and troughs happen in the exact same months across both the indices. However, the institutional cycles are perfectly synchronized here. So the only reason the ADR chart looks much weaker and deeper is the multi-year depreciation of the Indian rupee against the US dollars. So the currency conversion acts like a gravity well, pulling the US chart down. Okay, so that's it for today. Hope we all have learned something interesting and new about comparing the same chart across the two indices. See you next time. Thank you.